Hi, everybody. Welcome. Thanks for being on time. Going to give this a couple minutes for people to filter in, and then we will get started. I hope most of you are not buried under snow or experiencing freezing temperatures. Bert and I are, but if you are,
Yes.
I hope you're surviving and at least getting some snowball fights and sledding in.
Yeah, I think
All right.
I think it's too cold for snowball fights. I think the snow is too fluffy. It won't pack.
Yeah, it's been very, very difficult forming snowballs the past couple of days in Nashville. All right, we got plenty of people in, so we will get started and try to use this time as well as we can. Welcome everybody to Gus' first tax webinar of the year, understanding early stage taxes for C Corps. Just so everybody knows, we will be recording this session. We will send it around to everybody who attended, everybody who RSVP'd, and also post it on YouTube for all the folks who couldn't attend. Very excited today to have a newer Gus partner with us. KMK Ventures. They are a full service bookkeeping, accounting, and financial services firm, highly recommended from some of our other partners over at Forecaster. So really excited to have them with us today. We've got Bert Wilson with us today, Client Success Manager at KMK, and he is going to walk us through just some top level information about corporate taxes in the United States with a focus on kind of early stage venture-backed or venture tangential companies. We'll go through his presentation. You can go ahead and plop questions in the Q&A in the chat during that, and then we'll have about 10 or 15 minutes at the end to go through those questions. So Bert, I will hand it over to you. Thank you so much for being here with us today, and let's get started.
Great. Thank you, Peter, and hello, everyone, and welcome to our session. Welcome to Understanding Early Stage and Taxes for C Corporations. I am Bert Wilson, CPA. I'm the Client Success Manager and U.S. Representative for the KMK Ventures. And I've been specializing in business accounting and tax for, well, over 20 years. I really don't want to tell you how many years it's been, but it's been more than 20. And just to get things kicked off, just a little bit of housekeeping before we begin. And that is, please use the Q&A feature to submit your questions or comments. We'll address these at the end of the webinar, so we won't be specifically jumping into it right away. We'll wait till the end for the Q&A section. Also, please note that the chat's visible to all attendees, so avoid including any kind of sensitive information in the chat. If you have any sensitive questions, please feel free to email them to info@kmkventures.com and just put webinar in the subject line. Finally, as a disclaimer, this session is educational in nature and should not be construed as tax advice. So to kick things off, the types of taxes we're going to be reviewing today, taxes and compliance, is federal income tax, state, Delaware Franchise Tax, sales tax, payroll tax, and then the new FinCEN BOI reporting. To start with, what are the benefits of a corporation? Corporations, some of the benefits of being a corporation is that the corporation is treated as a separate entity, so a separate person legally. And it's required to keep proper records maintained in order to shield its owners from personal liability. The second advantage is that investors often prefer funding corporate structures because there's usually more options for liquidity and exit type strategies than other formation structures. Third, tax is calculated separately from the individual level, so it makes it easier for an investor to manage their personal taxes. And finally, accelerated programs often require a C Corp structure for admission into their programs. Some of the basics of the corporation structure is that the ownership is by shareholders, and the corporations are owned by shareholders and must be managed by a form of business arrangement or business structure. They have to be, in order for you to be authorized to conduct or to contract business on behalf of the corporation, such as signing tax returns or applying for loans, you have to have an officer, president, secretary, CEO, treasurer, something of that nature to be authorized to contract on behalf of the corporation. Another important feature is that minutes must be kept for all meetings. So you must have at least an initial meeting and then at a minimum annual meetings, even for a single owner corporation. Formal agreements also have to be kept with related parties such as owners or closely held businesses of owners. More importantly is expenses. Personal expenses of shareholders should never be paid from the corporate bank account to avoid commingling. You should always have an accountable plan for business expense reimbursements. Commingling of funds between your personal and business expenses can cause the loss of liability protection or piercing the corporate veil, as it said, and that can create liabilities. It can void the liability protection, and you can create liabilities for the owners. Finally, a corporation should be entered into with the idea of earning a profit. Like a business that has high gross income and then zero net revenue is a target for the IRS as an audit target. So on to federal income tax basics. A tax return is filed to determine, how much tax an individual or a company owes to the government in any given year. Taxable income is just gross income minus deductions or exemptions allowed in that tax year under U.S. tax laws. Tax in the U.S. is owed when the income is earned. So it's important to make estimated payments on a quarterly basis to prevent penalties. If you send only an estimate payment for your Q4 taxes that are due, you might incur late payment penalties for Q1, 2, and 3. If you're going, so that's very important to get those estimated payments in on time in the quarter that the revenue is earned. Taxes are owed. Also, the fiscal year elections. If you decide you want to operate on a fiscal year instead of a calendar year, those elections should be made in the first year of filing the taxes. Otherwise, it's difficult and expensive process to change your fiscal year in future years. Another aspect of corporate income tax is that U.S. corporations are required to report and pay taxes on their worldwide taxable income each year. All domestic corporations must file an income tax return whether they have taxable income or not. One of the advantages of being a corporation, though, is the Tax Cuts and Jobs Act, that it replaced the graduated corporate tax structure that was in place prior and replaced it with a 21% corporate tax rate assessed on your taxable income. Also, that's one of the aspects of the TCJA that does not expire in 2025. The 21% flat rate was made permanent by Congress. There are many other aspects of the TCJA that are likely to expire after 2025. Finally, the last little tidbit on income tax returns is generally a C corporation must file their income tax by the 15th day of the fourth month after the end of its taxable or its fiscal year. For a calendar year taxpayer, that due date this year is going to be April 15th. If your U.S. corporation owns a foreign entity, Form 5471 is required to be filed. Form 5471 is the tax return for foreign corporations owned by a U.S. entity or person. It requires the foreign corporation to disclose its income statement and balance sheet. Corporations generally file Form 5471 if they meet either total U.S. ownership in that foreign entity is 50% or more, or if your corporation holds 10% or more of the voting power of that corporation, then Form 5471 is required. And it's 5471 is filed as an attachment on your normal income tax return. And it's filed at the same time, and the due date is the same due date as your tax return, including any kind of extensions that you filed. And it's important to file these properly, because if Form 5471 is not filed, or if it's incorrectly filed, there's a $10,000 penalty that can be assessed. And then a final little note on Form 5471 is if you do have a requirement to file Form 5471, you may also have a filing requirement for the FBAR reports, which is to report foreign bank accounts and assets. If a foreign individual or an entity owns stock in your corporation, you may also be required to file Form 5472. 5472 is an attachment to your tax return as well, and it provides information on reportable transactions that occur during the tax year of the reporting of the foreign. Let me back up a little bit. It's reportable transactions that occur during the year for a reporting corporation that has foreign domestic related party transactions. A reporting corporation is one that is 25% foreign owned, meaning that at least 25% of the company is owned by a non-U.S. person or corporation or entity. Reportable transactions are between the U.S. corporation and the foreign shareholders. Some examples of some reportable transactions include sale of inventory, rents, royalties, commissions, loan payments, etc. This one also has a very high penalty possibility if you fail to file this form. The IRS will automatically say, if you fail to file the Form 5472 on time, the IRS will automatically send you a $25,000 penalty assessment letter. Corporations can do an S-corp election. With a C-corp, there's the aspect of double taxation. And the double taxation is because the corporation is taxed on its entity level, and then also the individual shareholders are taxed when dividends are paid. If you choose, you can file an S-corp election to have the income flow through to your personal tax return and then pay taxes at your individual rate. However, an S-corp election must be filed within 75 days within 75 days of the time of the date that you request the election. And this can be the date of formation or the start of any calendar year. So within 75 days of any calendar year. An S corporation still needs to file a federal income tax return, but the income, rather than being taxable, is presented to you on a Form K-1 that gets reported on your personal tax return. One of the problems with an S-corp election is that investors typically do not like to invest in S-corps. And the reason being is S corporations can only have individual owners. You can't have foreign owners, and you cannot have entities as owners. And you can only have one class of stock. So it makes it difficult to attract investors. Sometimes corporations pay their founders or their employees in stock and on an investment arrangement. If founders or employees are paid in corporate stock and they have a vesting arrangement, the income is reported and taxable when earned, and it's considered earned when the stock vests. To help you, you can make an 83B election. And what that is choosing to be taxed on the stock now rather than when it vests. Some of the advantages of this is that as a business grows, it's typically more valuable later as the business is growing. So the potential tax due is much higher in an older, more established business. So you can choose an 83B election and choose to be taxed on it today at the lower rates, which could be substantially smaller than a few years from now. And but however, there is a drawback to an 83B election, and that is if you make that election, you pay the tax today. If you never do vest the shares, so if you never actually do go through with the vesting of the shares, you can't take a deduction on that tax later. But again, offering a lot of things in a stock, another problem is that unvested shares can create a high Delaware franchise tax. So we're going to talk about Delaware franchise taxes a little bit later in this presentation. And with that, the calculation includes the shares outstanding, the shares unvested, total asset value, and the par value of the stock. And the more shares you have that are unvested outstanding, it can create a much higher Delaware franchise tax fee. So there's been much consternation with Section 174 and the research and experimentation rules. Uh, Section 174 is a tax change that was never intended to make it into law. Most experts expected Congress to push back Section 174 amendment to a later date, or simply just remove it and make it permanent. Thus, most people out there that if you had R&D expenses and you were looking to um, expense them, you probably filed an extension for your 2022 return, because we all anticipated that Congress was going to fix this in 2023 for the 2022 filing season, but it never happened. And so it kicked in when Section 174 expired. Starting with your 2022 tax return, R&D expenditures could no longer be expensed no longer expensed when incurred. Instead, they had to be capitalized and amortized over 5 years, 15 years if it's foreign expenditures. The R&D depreciation on equipment used in R&D is also treated as a Section 174 expenditure and also had to be capitalized. More importantly, software development is specifically included in the R&D expenditure that must be capitalized. And this caused trouble with web developers' salaries. Finally, there's a mid-year convention that's required. So it's a 5-year amortization with a mid-year convention, meaning that in the first year you can only expense 10% of your first year, and then 20 for each of the next 4 years, and then 10% in the final 5.5 year, fifth year. And that mid-year convention created big problems, particularly for software businesses. Software businesses could be particularly hit particularly hard because software engineers can no longer be accounted for as direct costs in the year that they're paid. And if you want to take a look at what this can do to a software company, this little table shows you quickly the way it was in the past and the way it is now going forward. In the year 2021, if you had $1 million in software engineering labor, you could expense that in the cost. You could expense that cost in the year that it was paid. So it made it $1 million deductible in the year that it was incurred. So zero profit and zero tax due on that. In 2022, with the changes to Section 174, that $1 million, you can only write off 100,000 now, because again, that mid-year convention, you can only write off 10%. And so you can only write off $100,000, and that leaves 900,000 in potential profit that you have to pay taxes on. So that would be $189,000 due in this tax year 2023. Also, it will catch up in future years, but it takes a while to get caught up. So in the second year, for example, you have another $1 million. Now this year you can write off the 20%. So you've got, of that $1 million after the year 2, you've got the 10% for last year and the 20% for this year. And the 20%, actually, let me take that back. You've got 10% of this year's $1 million plus 20% of last year's $20 million, which is now a $200,000 write-off, but you're still going to be showing profit of $700,000, so a $147,000 tax bill for 2024. So that kind of explains how the how this change in this rule is really affecting people. So along with R&E, which is Section 174, you have R&D tax credit changes. So for the R&D tax credit for qualifying costs, so tax credits, so all of your R&D expenses, you can incur tax credits on qualifying expenses. The R&D credit is for qualifying costs must be spent in the U.S., and there is a bias toward employees versus contractors, because the R&D tax credit is taken against your FICA and your Medicare taxes. And so this credit is roughly 20% of qualifying expenses, and it can be used to offset your payroll tax. And this is brand new for 2023. The credit is actually doubled. because in the past you had a total credit available of up to $250,000. Starting for the 2023 tax year, you can have a credit of up to $250,000 against your Social Security tax, as well as $250,000 for your Medicare tax. However, keep in mind that they now are requiring that due diligence is performed before filing this tax return, not in advance of an audit. So make sure that you have all of your paperwork, all your ducks in a row when you're claiming the credit. Don't go back and try and recalculate and re-estimate all of this in the event of an audit. So should you be claiming R&D tax credits? One of the problems is that there is a much higher litigation risk because there are all these R&D tax credit mills out there with questionable practices. They have some unethical practices, and they're just collecting fees, and they're hoping that they're going to miss on the audit lottery. So they're taking all sorts of extra credits that may or may not be due. And so it's very important to have a reputable person prepare your Form 6765. So do you want to claim R&D tax credits? Well, yes, actually, even though the litigation risk is higher and the IRS is in the big hiring process, and there's 87,000 new IRS agents, and they're promising to target businesses, this is still one of the only credits that can immediately benefit a startup. And the increase in payroll offset to $500,000 for 2023 makes this credit more valuable than ever. So again, just make sure that you're using someone reputable when preparing your Form 6765, which is the form that you use to file with your tax return to claim that credit. And then those credits are offset against your taxes on your 941 when you're paying, when your payroll taxes are being collected. You get to reduce that from on your Form 941 when you're paying the IRS. Something new this year is the FinCEN beneficial ownership reporting. This is a new requirement that it's actually called the anti-money laundering legislation is what it's for. And many companies are going to be required to report their information to FinCEN about the individuals who ultimately own or control the corporation. FinCEN began accepting reports on January 1st of this year. Reporting companies that were created. So if your business was in business prior to January 1st of this year, your first BOI report will be due by January 1st of 2025. If your business was created after January 1st, so if you're a brand new company, you only have 90 calendar days to file your first initial BOI report. So keep those dates in mind. Again, if you were created and established prior to January 1st of this year, your filing requirement isn't until January 1st of 2025. But if you were created after the 1st of this year, you have a requirement within 90 days to make that filing. And this is one of those things that there's been much concern, and there's been a lot of concern by business owners about the added burden. So, one more filing burden that's created that is needed to be done. However, the final form was just recently released, and I took a look at it, and it seems to be very quick and easy. To take a look at the form, you can go to boiefiling.fincen.gov. And what the report looks like is just this. And it's a pretty simple walkthrough. It's just sort of a step-by-step process. And you're just clicking boxes, entering your data. And the filing seems to take, I would say, probably no more than about 10 minutes to do this filing for most companies. So it wasn't as big of a burden as we all thought that it was going to be. So next, let's move on to state income tax. 44 of the states levy a corporate income tax or an income tax on the corporations. Each state has different rules as to whether an out-of-state business is required to file a corporate income tax in their state. Generally, a corporation must have nexus in order to have a filing requirement. Nexus is defined as some definitive link or minimum connection between the corporation and the state that's sufficient to cause a filing requirement. Some of the factors that establish nexus in any given state is a physical presence in the state, employees in the state, or economic activity, sales above a certain threshold in that state. Next, the Delaware Franchise Tax. So many accelerated programs prefer that corporations be incorporated in the state of Delaware. Any corporation that is incorporated in Delaware, regardless of where you're conducting business, must file an annual franchise tax report and pay that franchise fee. The franchise taxes and the annual report are due no later than March 1st, so the date's coming up quick. And so make sure you file on time to avoid any kind of penalties and interest. If you do fail to file, you'll likely receive a notice from the state of Delaware showing some outrageous amount of tax due as their estimated filing fee. I really don't know who in Delaware is calculating these estimates, but they're always very high. The important thing to know is that the actual filing fee is going to be nowhere near what their estimated amount is. I mean, I've seen some of these notices come out with an estimated fee of $80,000. Just so you know, the typical filing fee is normally around $600 once you actually enter the data into their form and complete the filing. The minimum filing is $400. So again, just be sure to file on time to avoid any kind of penalties and interest. March 1st. Next, sales tax. So we've all heard the landmark Supreme Court case, South Dakota versus Wayfair. And it completely changed how sales tax was collected by the states and made it easier for the states to impose a requirement on you to collect and remit sales taxes. Now, most online sales of goods are taxable in most states. However, rather than the biggest problem is in the past, you only had to file and pay sales tax if you had nexus, physical nexus in that state. And again, physical nexus is people, products, things in that state that gave you a connection. Now, economic nexus must be considered. As a general rule of thumb, most states have kind of settled in, and most of them use pretty much the same threshold level. And the economic nexus that causes the filing requirement for most states is around $100,000 in taxable sales or 200 individual transactions per year. So just keep that in mind. Don't file for a bunch of in a bunch of states, for one or two quick sales in that state. It's not worth the filing headaches. And just wait till you hit the threshold, and we can help you determine when you've hit those thresholds. Another aspect of sales tax is service income. Businesses that sell service across multiple states really need to be careful and need to take a look at where those services are subject to sales tax. Most states don't tax services, but Delaware, Hawaii, New Mexico, South Dakota, they tax most services. Also, other states like Washington, Texas, and Minnesota, they're expanding the taxability of services. They're all looking for new ways to create revenue. And so the rules are changing frequently as far as what services are taxable and which states tax services. Another issue is drop shipping. Through online marketplaces, it now creates, you're drop shipping into multiple states, and it creates the possibility for taxability in most states. However, it doesn't mean you need to register and pay that tax in every state today. In fact, if you're selling like through an Amazon marketplace, typically they're collecting and remitting the sales tax, so you don't have to. You would just count in when you're taking a look at your your economic nexus values, is which sales you're making through your website directly into that state. One more huge gray area is SaaS income tax liability. So software as a service and software itself is a real gray area because it can be argued. You used to have rules surrounding, because most software was on a disk. And if you received some hard form of a disk, that was considered a taxable sale item, whereas if it was on the cloud, it wasn't taxable. Well, the rules have been changing, and it's a real gray area now as to whether a digital product is a taxable sale or if it's a service, a non-taxable service. Thus, sales tax nexus has to be really carefully watched for a SaaS company. On to payroll taxes. So independent contractors versus employees. It's an advantage for a business to designate workers as independent contractors because you're not going to have to file, remit, collect taxes on that employee. Payroll tax filing requirements are different for independent contractors versus employees. As an employee, you generally, an employee is generally designated as a person who receives specific direction from the employer about when, where, and how to do their job. An independent contractor is a worker who's in charge of themselves. So they're responsible for deciding how the job gets done. Typically, independent contractors provide their own tools, equipment, et cetera, when they're on the job. And the employer gives very little guidance. And employer normally controls more details when, where, and how the employee performs their work. So again, these are kind of some designating factors of whether or not someone can be construed as an independent contractor or an employee. Now, states would like to see all workers classified as employees. Most states have documentation and rules regarding designation of workers as independent contractors. The states want all of these people classified as employees so they can collect the unemployment tax and a lot of the other programs that they have set up in their state that are only required of employees versus the contractors. So it's a much bigger expense for you as an employee, but the states want everybody classified as employees. As an employee, the U.S. employee, the employer has to withhold income tax and FICA tax from their paychecks and remit it to the IRS. State and local governments also may require withholding on wage income, and businesses also pay state taxes, including taxes, income taxes, and unemployment taxes. Finally, having employees triggers other compliance aspects. So like the Family Leave Act, equally offering benefits to employees on healthcare plans, equally offering benefits for employee pension plans, etc. And one thing to keep in mind with employee payroll taxes is pay them on time. Trust fund recovery penalties are the most harsh of all IRS penalties. They can be anywhere from 50 to 100% of the taxes owed. And managers can be personally held liable for those payroll taxes. So you should always make sure to remit your payroll taxes on time. Independent contractors. So what are the rules around independent contractors? Federal requirements for reporting amounts paid to independent contractors include Form 1099 NEC. It has to be issued by January 31st each year if you paid any U.S. contractor greater than $600 in the prior year. The Form W-9 should be obtained from each contractor before hiring them. In fact, all vendors, you should collect a W-9 from all vendors before making any payment, because it's always difficult to chase the W-9s at the end of the year in order to meet the filing requirement of January 31st of the 1099 NECs. Also, Form W-8 is used to collect information for non-U.S. workers to prove that they are not U.S. persons. Form W-8 is not filed anywhere, but you should always collect it on foreign workers, and you should keep it on file because in the event of an audit, you need to have the Form W-8 on file. One of the problems, again, because independent contractors are, the states want them to be considered employees. States are sort of changing their reporting requirements, and it's increasing some of the burdens. And California is leading the charge in this. California companies must withhold 7% on payments made to non-resident contractors from California source income that exceeds $1,500 in a calendar year. So the state's requiring you to make withholdings, send it in just to make sure that they're not missing out on those tax dollars of those independent contractors. Some of the ways to make sure that because states prefer workers to be designated as employees, in order to document the worker's status as an independent contractor, you should always ask for a bill. Some of the other aspects that will help you prove that it's an independent contractor and not an employee is that you're not their only source of income, you don't set their hours, and you're not providing the tools for the job. Those are all areas that can help you demonstrate that it's an independent contractor and not an employee. 1099-K updates. So this is the payment processing platforms and what they're sending money out for. And so just like last year, the IRS again announced a last-minute delay for implementing the new 1099-K rules. And so for tax year 2023 filing season, the current $20,000 and 200 transaction threshold is what's in place for the 2023 tax filing season. For this year, for 2024, the threshold for third-party platform payments will be $5,000. And what they're trying to do is they're trying to phase in the implementation of the ultimate rule change that they've decided on of $600. The 1099-K instructions specify that Form W-8 should be obtained for all individuals providing services outside the U.S. Also, payers that have performed any kind of backup withholding during the calendar year must file Form 1099-K with the IRS and furnish a copy to the payee if the payments and the withholdings from the payee exceed $600 for the calendar year. One of the things with the 1099-K is don't ignore them. When you get those, in the future, you're going to be receiving 1099-Ks from Venmo, from PayPal, from credit cards, etc. And what you want to do is, if you're making a payment through, Venmo, for example, make sure you designate on the payment that it's not for services, because a lot of times you're just reimbursing each other back and forth in a platform like that. And then when you receive this 1099-K, you're going to have a filing requirement for that income, and the IRS is going to audit you if they don't see that income showing up on your tax return. So like anything else, you'll have to use it like if you receive a 1099-K, you'll have to prepare it as if it's like a Schedule C business, for example, and apply credits against that to offset the income for expenses that you've incurred or for expense reimbursements, etc. So what changes are coming this year? So for this filing season, for the 2023 tax year, there were quite a few changes that were put in place. Number one, there's a commercial clean vehicle credit that's available for all vehicles that were placed in service after December 31st, 2022, if it's a qualified manufacturer listed on the IRS site. So that's a nice credit that's available now to commercial entities, not just individuals. However, there's another new thing that jumped in. It's a 1% excise tax for the repurchase of corporate stocks from covered corporations. Now, covered corporation is not going to affect most of you because a covered corporation is one that's traded on an exchange. But that 1% excise tax is for repurchases after December 31st of 2022, and the tax is 1% of the fair market value of the stock that was repurchased. Some other credits that are available for this year is there's some clean energy credits. There's carbon oxide sequestration credits. There's clean and / alternative fuel credits. There's also credits for small business employer pension startup costs. That was in place prior, but the credits improved. So this year, the credit has been increased from 50% of the startup costs up to 100% of the startup costs. Also, the additional credit on the per employee cap was increased from $500 to $1,000 per employee as the cap for the startup costs. Finally, the temporary exemption of the 100% deduction for business meals, that expired December 31st, 2022. So for this tax year, for 2023, meals are back to 50% deductible. So business meals with clients are back to being only 50% deductible. And as always, entertainment expenses are 0% deductible. So what changes are coming for 2024 and beyond? As I mentioned, there's a number of provisions from the Tax Cuts and Jobs Act that are expiring after 2025. Personally, I don't anticipate legislation to extend any of the TCJA provisions until after the election. It's not likely they're going to take any action on that until after this upcoming election. But an example of some of the top provisions, individual related provisions that are expiring if they don't do something about it, is the top tax rates. So the top tax rate is going to increase from 37% up to 39% for individuals. The current standard deduction, which is more than double what it was prior, is going to drop back down to the smaller standard deduction. But the SALT, so the state and local income tax deduction, it was capped at $10,000. That cap will go away if they don't do something to change it. So that's for individuals. For businesses, there are a few important business-related provisions expiring as well. One is the 20% QBI deduction for pass-through entities. So if you are an S-corp or an LLC, you are able to write off a 20% of your qualified business income as a deduction. That expires with the expiration of the Tax Cuts and Jobs Act. Also, the elevated levels of Section 179 expensing limits. Accelerated depreciation levels will be reduced back to likely back to smaller amounts. So 80% might be the maximum. We just have to see where it goes. But these are some of the provisions that are expiring. And lastly is right now there's an elevated estate tax and gift tax exemption. So currently, in the event that you die or gift, there's, the first approximate $13 million of your estate is exempt from taxes. At the end of the TCJA, this is going to drop back down to the levels that were somewhere between probably 1 million and 5 million as the exemption on what you can pass through to your heirs. Also, for 2024, state budgets are in focus. So in many states, income tax is out and retail sales tax and fees is in. So this year in 2024, approximately 30 states have lowered their income tax rates in favor of moving more toward a consumption taxation. So sales tax, for example. And so income taxes are going down in 30 states, but they're going up in many states on the sales tax side. So it's sort of just a shift in the way they work their budgets. Another thing is all the new fees. And these, they call them fees, but they're truly taxes masquerading as a fee. For example, Colorado started this off with the retail delivery fee. And now there's several more states that are looking to add this retail delivery fee as well. Also, there's bag fees and a variety of other things that they're coming up with. And they're calling them fees to seem like they're not a high tax state, but they really are. These fees are just taxes masquerading as a fee. And more and more states are also assessing income tax for remote activities. So if you are working for a Wyoming, a California company, but you're living in Montana, which is a no tax state, that they're going to come after you for your remote activity, claiming that your source income is California. So here's a little bonus for today's presentation. This is some bonus material to help you a little bit. I'm going to provide you just a few tax planning ideas. So these are some things that you can do throughout this year to help you reduce a possible tax burden at the end of the year. The first is income shifting. So this is an important way to help you do your planning. And income shifting is done in 3 different ways. First, it's through years, people, and entities. So when I say years, what I'm saying is you're going to either move forward or back at the end of the year, your revenues and your expenses, depending on which year you want to be taxed in. So if you have plenty of deductions this year, you might want to move some income forward and invoice it at the end of the year. If you are planning on big profits this year, you might want to wait to invoice till, these are things that you do right at the end of the year, and you can move it to the end to next year, so the revenue gets moved into next year's revenue and offset with expenses next year. Or in the same thing with expenses, you can pay expenses this year versus next year. So income shifting in years. Another is people. So if you are eligible for bonuses, commissions, payroll, you may want to work something out where you hire your kids or your spouse, and you can hire your kids and you can shift some of the income from your tax to a lower cost individual, a lower taxed individual, which would be your child. And that can be used to help save for income for college years. And then finally, entities. The way you income shift with entities is your stock ownership, rather than being in your name, might be in an entity. And that entity can be in a C-corp, an LLC, or an S-corp, depending on how you want to be taxed. So again, just shift your income by years, by people, by entity. We just work out the numbers to see which one works the best. Okay, harvest tax losses. That's another thing. So at the end of the year, if you're expecting some big capital gains, perhaps sell some stocks or some investments that were losers. Take advantage of clean vehicle and clean energy credits. Another one is fixed assets purchases, including company vehicles. So again, if you're doing quite well and you need to reduce your tax burden, you can purchase company vehicles. And you don't have to just have one company vehicle. You can have multiple company vehicles, and that will put the asset through your business and the cost through the business. And the last one is evaluate whether or not you should be purchasing the building that you're in, or the office space, or leasing it. We can do some calculations. We can help you with those calculations and help you come up with a formula to determine whether you're going to be better off buying your business, or buying your building, or leasing office space. And buying the building sometimes is beneficial because you have the depreciation, the interest, and the taxes you can write off. But you're also building wealth because the business or the building is increasing in value. So those are just some quick tax reduction strategies that we could help you with if you have questions on those. Finally, how can KMK help you? So we work with a large number of business entities, the corporations, C corporations, S corporations, partnerships, etc. And we provide accounting, bookkeeping services, and financial reporting. We also do tax preparation services, and we do tax preparation and other services, like we can help you file sales tax returns. We can help you with processing payroll tax forms. We can help you with accounts receivable, accounts payable, etc. We can also have consultations with you to discuss anything that you need as far as any other informational returns that might be needed. We can do assistance with tax planning strategies. We can customize support and guidance throughout the tax preparation process. So you're not going to be in the dark. We're going to help you, and we're going to ask you if we see that something's missing during your tax preparation process. We're going to say, well, what about this? What about that? And help you with that. Finally, we can assist you with tax audits and appeals. So if you receive those nasty tax notifications, we can help you resolve those. And we can provide year-round support and advice. So what does this cost? As a GUS client, you will receive a discount from our best pricing. And our best pricing is as follows. So for tax preparation, if we have three different levels: starter, growth, and established. The starter is for businesses with 10,000 or less in annual gross revenues or expenses. Growth is between 10,000 and $1 million, and established is greater than $1 million. And these are the prices that we would charge for your tax preparation services. And then for bookkeeping, you also get a discount in bookkeeping. So again, same levels: starter, growth, and established. And bookkeeping ranges anywhere from $195 to $695. And as here's the Gust partner page. So in order to get those discounts, all you have to do is click this link that's in this presentation, and you can receive those discounts from our services. And that's it. So, Peter, I think you've been collecting questions, and so I guess now is
Absolutely.
Q&A.
Well, thank you so much, first of all, Bert. And just so everybody's aware, we will send out links to KMK and a recording of the video after this. Don't worry, we will make it very easy for you to get in touch with them. And then some more quick info. This is part of Gus' kind of educational series at the 101 level. We have recently launched a new program called Mission Control that is helping startups dive a little bit deeper into the education and nuts and bolts. It is experts, it is office hours, it is pitch deck and financial model teardowns. It is week-to-week opportunities to connect with experts, the team from Gust, in a more intimate setting, and really build up your network and navigate. The goal is to help you save on billable hours, avoid critical mistakes, and accelerate progress. Bert will be joining us again next week for a 1-hour virtual face-to-face Q&A for Mission Control subscribers, so we can dive into a little bit more depth and navigate some of the trickier issues. And we have week-to-week programming. So if you are interested in that, that sounds like something that would be helpful to your venture, I will post a link in the chat. Come and check it out. And with that, we will move into Q&A. All right, first up, we've got Jan. Jan is a Mission Control customer. So Jan, we may shift some of your more complicated questions into those sessions next week. But first up, we have, can you elaborate on a foreign entity having a C-corp US entity tax obligation, double tax arrangements if existing? So Jan, I believe, is thinking about having a US branch of an existing foreign corporation and wondering about the potential income tax offshoots of that arrangement.
Okay. Yeah, so that would be the 5470. So you're saying that a foreign entity that owns a US branch?
Yep.
Yep. Okay, yeah. So you would have a tax filing requirement. Your taxes on your foreign income is not going to be taxable in the U.S., but it will be split out, and so that's the 5472 filing that's required. So you have to identify you're going to have a U.S. entity filing. You're actually going to have both a 5471 and a 5472 filing requirement it's the 5472. Sorry, but yeah, you'll be responsible for taxation or taxes on your U.S. source income. Is that
Awesome.
is
I
that the
think that
question?
is a good start, and we'll have an opportunity to dive into Jan's questions next week as well.
Yeah.
All right, next up, we've got somebody with a Canadian C Corp that is a software as a service business, and they are selling into the US. What should they
Mhm.
be thinking about in terms of sales tax burden, potential income tax burden?
Yeah. So that's one of those ones that's the big problem is the gray area. And so every state is a little bit different. So that's when it's important to get on the Department of Revenue of the various states that you're going to be selling in and see what their rules and their regulations are. As I said, many states would consider it a service sale, and it would be non-taxable of a SaaS type company sale if you're not providing something in a physical disk type format. And so, but certain states will tax it. And so it's just a state by state issue that you need to read the rules in that particular state.
And any
I know.
differences there between a Canadian corporation and a US corporation? Would a Canadian corporation have to be on the lookout for anything additional or different than a US corporation?
No, because again, you're going to create a filing requirement in the U.S. of your U.S. source income, and so and the states are going to be you're going to have the same filing requirements in the states with the economic nexus and what have you as you're selling into the various states. But
Yeah,
it's
and
a
I think
state,
this is,
not a
yeah,
federal.
it's an interesting evolution in the tax code
Yeah.
because just like you have economic and physical nexus in the US, the idea of economic nexus doesn't require a physical nexus in the US. So there's like these whole new question marks that come with that decision.
Yes.
Okay, next up, we have a question around grant income and research and development. It looks like this is an NIH grant or some state government grant funding, anything to be on the lookout there in terms of how it relates to R&D costs, costs incurred, for the grant, if there's any
Mhm.
additional things to keep on the radar from a taxation standpoint.
A lot of those are depending on the grant itself. It's the terms of the grant. So oftentimes, when you receive a grant, it's designated where it needs to be spent. And then you would have offsetting costs for that. But grant income is typically taxable revenue and needs to be reported as taxable revenue. And a lot of the expenses. So, for example, I am aware of some of the people that we do business with that are getting grants, and the grant was actually to hire more R&D people. So it was R&D payroll was going against that grant, and they had to reply. They have to provide reports, on a quarterly basis of where the grant money was spent. But those same employees, because they were hired as R&D, were used and calculated in the R&D tax credit. So again, it's important, as I mentioned before, to have a reputable person doing the calculations, because you're going to find these farms out there that are just going to say, oh yeah, all of this goes into R&D and we're going to get an R&D tax credit for all this, that, and the other thing. But it's important to go in and truly analyze, what percentage of their time was on R&D, what percentage of the time was in G&A, and to split some of those costs between research and between G&A and other functions that they're operating on.
And now, Bert, does KMK actually handle R&D tax credit filings?
Yeah, it's Form 6765, and it's filed with their income tax return. Now, if you're intending to do the R&D tax credit filing, and you want to, it'd be a separate engagement. And we'd probably connect you up with one of our specialists that would come in and do the evaluations and sit down with you and determine exactly which expenses were research related, which employees were research related, splitting your payroll. It's quite a process. And so, get us early on so we can start the work early. And because oftentimes what I've found is most people that are taking advantage of the R&D tax credits, we end up extending their returns. So we have time
Yep.
to do all the work.
Very often, and good to keep in mind generally for the R&D tax credit, that is going to be most applicable to you in terms of financial benefit if you do
Mhm.
have W-2 employees that are
Yeah.
actively engaged in R&D. So if you just have contractors, if you're just starting out, it's probably not worth spending too much time on in those early years. But once you have W-2 employees, take a look.
Yeah, and because the R&D tax credit is offset against payroll taxes.
Yep. All right, next one, kind of related to the previous one, but in terms of Section 174, if you do have grant funding, take an S-corp grant, for example, that is the intended use is for R&D costs, and some of those R&D costs are going to be spent on R&D software engineering employees. How does that now interplay with Section 174? Does that just make the grant effectively less effective by in that tax year? Like, what's the best way to
Yes,
think about it?
yes, and that's what I was pointing out in the presentation, is that it hits the software companies much harder than others, because that money. So you're going to get the grant, which is taxable income, and you're only going to be able to write off 10% of the salaries against that research, and 10% this year, 20% next year, 20% the year after that. So it will roll up and it will catch up going forward. But those initial years, you may end up with a unexpected tax liability.
Yeah, and again, and I think likely unintentionally based on the way this thing came into law, this is
Mhm.
going to affect companies that are really kind of at the bottom of that J curve and really starting to
Yeah.
get started and ramp up W-2 employees and R&D expenses. It's going to hit them in those critical formative years. So we'll have to see what happens with it. But again, if you're just contractors, and Section 174, probably not the most important thing to have top of mind. But if you are building a base of W-2 employees who are actively engaged in R&D and software development, then it's something that you need to keep on the radar.
Yeah, and as you mentioned, Peter, it's nobody ever expected that to happen. I mean, everyone I know that had research expenses extended their tax return last year. because they were expecting an extender to be passed through Congress, and they didn't do it. So,
All right. Another semi-related one. Company with very little revenue but spent on R&D. Can they wait until the following year when there is actually something to offset, or do they need to file something in the year the R&D was paid for? Assuming this is towards the R&D tax credit.
so the R&D tax credit is based on the expenses of that particular year. You can carry it forward. So you can have, you can have a pretty good size R&D tax credit that will be used until gone. And so it'll still continue into the following years, but it is based on the expense of this. You can't make the expenses this year and then take the credit next year for it.
Yeah, and I think importantly too, if you incur the expenses this year, you need to, in most cases, file the reporting on those expenses this year in order to carry them forward. You can't
Yeah,
wait to file until you know that you will have things that you can offset in the future years.
yeah,
Okay. Ooh, this is a fun one. And Bert, we're at time. If you can stick with us for 4 more minutes, I think we can get
sure,
through a bunch more. But
sure.
Bethany is asking about a C Corp created a couple years ago. They did not send in an 83B election, but they would like to count the years that they have since held the stock towards the QSBS holding period. Do you have to forego the 83B election? I can take a piece of this one because this is
Yeah,
Gus launch territory. But generally, if you miss the 83B filing window, you have very limited recourse in terms of fixing that. You can't really nullify the stock grant and then re-grant it under the same terms. The IRS will just say that you didn't really do anything. You filed the paperwork, but it didn't change the circumstances of the original grant. So likely in that case, especially if you want to form that QSBS holding period at the time of the original grant, you may be out of luck and you may have to take the income tax hit on the 83B in exchange for hopefully the capital gains advantage that you will get by locking in that QSBS holding period. But if you really want to figure out how to fix it, you're going to have to spend some money on a lawyer and an accountant.
yeah.
Okay. All right. Timothy asks, is startup investment treated as income for a corporation?
Startup investment, not startup expenses.
Yep. So this would be, I assume, an
Oh,
equity.
so like your equity investment, I would
Yep.
record that as either your equity, so your shares plus additional paid in capital, so it'd be on your equity statement, or better yet, perhaps an owner's loan, a shareholder's loan, because then you can pay it back without a tax liability. But no, it would not be income; it would be investment in the company as either, like I say, equity or a shareholder's loan.
Awesome. Thank you. All right. Another interesting one. Company has taken in money via a safe or other convertible instrument at a certain valuation cap. They want to make some grants of shares after that. Do they need to utilize the valuation cap to set the price of the shares? Another interesting one in Gus launch territory. This
Yeah,
one's a wild one. So generally, in the earliest days, you're issuing common stock. You're not even issuing stock options yet. In that case, you're typically, and in the very earliest days, issuing at par value. And that stays that way until you build value in the company. Now, taking an investment through a safe and convertible note inarguably builds some value in the company. You now have some money in your bank account. But typically, your investor-facing valuation and the valuation of the shares that investors will eventually buy will be priced significantly higher than the shares of common stock that are held by employees and contractors. Reason being is that eventually when investors purchase actual shares, they will be preferred shares. They will come with additional rights and preferences that help investors protect their investment, get their money back, dictate how the liquidity works for them, a whole bunch of levers that make those shares more valuable theoretically than the common stock. In those cases, the price can fluctuate. So the price at which, or the valuation at which you take an investment does not immediately impact the value of your common shares, which is good because that means the common shares can stay lower and make it effectively cheaper for the company to incentivize new hires by showing them the difference in that potential spread. Now, as the company gets closer and closer to a liquidity event, those prices will converge and they will essentially become the same when everything converts at a merger, acquisition, or an IPO. Now, a safe and convertible note, they aren't actually equity yet. Well, I should rephrase that. From the IRS's standpoint, they're absolutely an equity investment. From the
Yeah,
SEC's
it's one
standpoint,
of those hybrid things. Yeah.
absolutely an equity investment. However, they don't own shares yet. So you putting a valuation cap on the safe does not have necessarily an immediate impact on your common shares. Last wrinkle is when you adopt an option plan and issue options rather than stock. Options are things that people will have an opportunity to buy instead of shares issued at a specific date and time. In order to issue options to people, you will likely get a valuation of your common stock by an outside firm in order to give your company safe harbor on the strike price that you're going to issue options at. Strike price in this case will be synonymous with the price of those common shares. In those cases, you will typically get what's called a 409A valuation yearly to assess the value of the common stock once you are actually issuing options. In those cases, and even sometimes prior, the amount of money invested into the company and the revenue and the traction and the public comparables will affect the common stock price, and that price will go up. But it will generally go up on the order of once a year or once per interesting financial event, including fundraising. So if your revenue explodes or you get a huge fundraise, you will likely have to go and do a new 409A valuation to revalue your common shares. But getting money in via a safe or convertible note does not have immediate impact. Definitely talk to your lawyer. They may suggest that you board approve a valuation moving forward, but there is not an immediate correlation or an immediate impact from your valuation cap directly back to your common stock share price. Whew.
That was a mouthful.
Always is. Okay, I'm going to see if we have a couple more small ones that we can get to. All right. Well, we have a bunch more, but a lot of them are relatively complex. Tatiana, I will suggest that you reach out to KMK directly. You have enough going on that you should probably have a consult. And again, we will be doing more of this. If you are a Mission Control subscriber, you will have a one-on-one Q&A or a face-to-face Q&A next week for an hour, and we'll schedule an additional tax-focused office hours. If you're interested in Mission Control, come and see us. If you need some help on this stuff and you know you immediately need to talk to Bert and KMK, we will get you the links. And as always, as things progress, it is good to talk to a professional to make sure you understand the tax impact. If you're early and you want to keep an eye on the future, that's when you can come talk to us, and we'll let you know when it's time to talk with Bert and KMK.
Good.
Bert, thank you so much for being here. I really appreciate it. Last time for everybody, we will send out the recording and links about how to get in touch with KMK, likely later today or sometime tomorrow.
Thank you,
Thanks,
everybody.
Bert.
Thanks.